Sanmina, ticker symbol SANM, just delivered an absolute blowout print for their third quarter of fiscal 2026.
Oh, yeah, they crushed it. I mean, across the board.
Right, so we are talking about the kind of numbers that, force retail investors and the broader market to just aggressively reprice a stock on the spot.
Yeah, you have to rip up the old valuation models after a quarter like this.
Exactly. So let's hit the top line right away. Non-GAAP revenue came in at a staggering $3.46 billion.
Which is just massive.
It is. I mean, that completely crushes the high end of their own outlook, which was capped at $3.5 billion.
Right, and it flowed straight down to the bottom line, too.
Yeah, non-GAAP diluted EPS hit 3.31. And just for context for you listening, they had guided for a range of 2.55 to 2.85.
So they blew past it by a mile.
Right. But the real catalyst for the stock reaction, I think, is the forward visibility.
Oh, absolutely. The guidance is what really set this off.
Yeah, so Q4 revenue is now guided between 3.3 and 3.6 billion, with EPS targeting 3.05 to 3.35.
And they bumped the full year, too, right?
They did. The full year FY26 outlook was raised to a massive 14.3 billion range.
Up from, what, 13.7?
Yep, exactly.
Yeah.
Up from 13.7 billion. So, our mission for you today in this deep dive is to look under the hood of this earnings report.
Because a top-line beat is, it's a great headline, but we need to see the mechanics.
Right. We need to dissect exactly how they generated these numbers, look at segment performance, margin expansion, and really just stress test the underlying risks.
Yeah, to see if it's actually sustainable. And to do that, you kind of have to throw away the old models of what this company is.
Because they aren't just a basic manufacturer anymore.
Exactly. The days of treating Sanmina as this monolithic, low-margin assembly business are over.
Right.
You're looking at a company that is fundamentally bifurcated. The revenue mix is really telling a story of two radically different portfolios.
Okay, let's unpack this, because the data paints a really stark picture of that divide.
It really does.
So their first segment, which covers communications networks and, crucially, cloud and AI infrastructure, that has basically swallowed the company.
Yeah, it's massive now.
Right. It makes up 62% of their total revenue. In Q3 alone, it generated $2.148 billion.
Which, just to put that in perspective, is a 173.2% year-over-year growth.
That's just an astonishing number. I mean, a year ago, they were sitting at $786 million for that segment.
What's fascinating here is how AI is acting as this rising tide for their entire ecosystem.
Right. It's not just basic server racks anymore.
No, not at all. When we talk about AI infrastructure, the narrative usually gets dominated by the silicon, right?
Yeah, the chips, the semiconductor designers.
Exactly. But those chips don't exist in a vacuum. A next-generation AI server rack weighs, thousands of pounds.
And it runs incredibly hot.
So hot. You can't just stack these in a traditional data center and blow cold air down the aisle.
Right, that doesn't work anymore.
It doesn't. Sanmina is engineering the heavy physical plumbing that makes all this computationally possible.
We're talking about things like advanced liquid cooling manifolds, right?
Yeah, systems that have to circulate fluids inches away from millions of dollars of sensitive electronics.
Without a single micro leak.
Exactly. And that leads into the other side of their business, the remaining 38%.
Right, so that's the industrial, medical, defense, and auto segment.
Yeah.
That side brought in $1.316 billion, which is a very steady, stable 4.8% year-over-year growth.
It's the anchor.
Yeah, if I had to use an analogy, it's like a dual-engine rocket.
Oh, I like that.
Right. So one engine, the AI and cloud side, has been upgraded to nuclear power.
It's just launching them forward.
Exactly. While the other engine, the industrial and medical side, acts as this stabilizing gyroscope.
Just ensuring reliable baseline cash flow.
Right. It pays the overhead, keeps the lights on, and lets them take those aggressive swings on the high-growth AI contracts.
But even that stable 38% is starting to see the AI effect.
Wait, really? How so?
Yeah, well, management specifically highlighted this on the call. They are seeing expanding business in their energy sector, specifically designed for data centers.
Oh, right. Because you can't just plug a hyperscaler's new GPU cluster into a standard grid.
No, the power draw would instantly trip the infrastructure. Power density is the bottleneck of the entire AI revolution right now.
So they're building the power delivery mechanisms too.
Exactly. So that modest 4.8% growth in the legacy portfolio, it's actively positioning to capture the ancillary spend that has to happen just to turn the servers on.
That's a great point. So we have the explosive top-line growth, but let's transition to margins.
Yeah, because revenue is only half the story for retail investors.
Exactly. If that $3.46 billion is coming in at zero margin, it doesn't matter.
Worthless, yeah.
Right. But this is where Sanmina really separates itself. Their non-GAAP operating margin hit 8.0%,
Handily beating their 6.4 to 6.9% outlook.
beating by over a full percentage point in hardware is huge.
It's monumental. Moving margins in physical manufacturing, where you're dealing with, steel and copper and shipping logistics, is incredibly difficult.
Let's break down the segments driving that. Integrated Manufacturing Solutions, or IMS, gross margins jumped from 7.5% a year ago to 10.2%.
A huge jump.
And core Sanmina IMS revenue grew 14.1% natively.
Natively, yeah, before you even factor in ZT Systems.
Right, so let's talk about ZT Systems. They integrated them, and it contributed $1.1 billion in revenue, which was basically perfectly at the midpoint of their outlook.
And their Components, Products, and Services Division CPS grew revenue 29.2% year over year,
With margins up 120 basis points sequentially.
which proves their pricing power is holding strong.
Okay, let me stop you there and play devil's advocate for a second.
Sure.
Because if ZT Systems is projected to hit 4.8 to 5.0 billion for the 11-month period, which is what, an annualized run rate of $5 to $6 billion,
Roughly, yeah.
are they already hitting a ceiling on synergy realization? I mean, did this quarter pull forward future demand?
That's the classic fear, right?
Yeah.
That they just emptied the backlog to make Q3 look amazing.
Exactly. Did they just ship everything they could?
But the underlying mechanics show that's not what happened here.
Okay, why not?
The margin improvement wasn't just a windfall from bolting on ZT Systems. It was driven by a highly favorable product mix and disciplined cost management.
Meaning they are intentionally taking on better contracts.
Yes. And to prove it's not just management spin, you look at their non-GAAP pre-tax return on invested capital.
The ROIC.
Right. It sits at a highly efficient 39.1%.
39.1% for a capital-intensive manufacturing business.
It's staggering. It proves they are allocating capital flawlessly. For every dollar they invest, they're getting an exceptional return.
They aren't just chasing empty revenue.
Exactly. They haven't hit a ceiling. They've just established a completely new baseline for efficiency.
Which naturally leads to the management commentary, because that operational confidence was very clear when they talked about the future.
Oh yeah, they were not shy about raising the full-year guide.
Right. CEO Gers Sola stated flatly that they are confident in their ability to deliver $16 billion plus in revenue for FY27.
$16 billion. And he backed it up by saying bookings continue to be strong with a robust pipeline stretching all the way into FY28.
Here's where it gets really interesting.
Yeah.
If you look at the end-to-end capabilities diagram in their earnings deck, they're not just basic assemblers anymore.
Not at all.
They are providing liquid cooling manifolds, custom memory, full system architecture, and bus bars.
If we connect this to the bigger picture, Sanmina is basically positioning itself as the ultimate picks and shovels provider for the AI gold rush.
Oh, absolutely.
Like take bus bars, for example.
Yeah, explain that for a second.
So a bus bar is basically a massive metallic strip that conducts high currents of electricity within a server rack.
Right.
In an AI data center, the electricity surging into a single rack is so intense that standard cables would just melt.
Wow.
So Sanmina is engineering these custom bus bars that can safely deliver that power while fitting into, millimeter-tight constraints.
They are building the physical plumbing that makes AI computationally possible.
Exactly. But you have to remember, building that custom physical infrastructure requires massive capital.
Which brings up the liquidity check. How are they funding all this?
From a very strong position, they have $4.0 billion in total liquidity.
Nice.
And ending cash of $1.84 billion. But the best part, they have absolutely zero borrowings on their $1.5 billion revolver.
Zero. That is incredible, especially in this interest rate environment.
It gives them a massive competitive moat. They can fund their expansion without tapping expensive debt.
Okay, so we've got the explosive revenue, the margin expansion, the fortress balance sheet. But, every bullish thesis needs a stress test.
Of course, you have to look at what could go wrong.
Right. So let's pivot to the notable risks outlined in the safe harbor statement to give you a balanced view.
The most immediate one is the ZT Systems integration.
Right. Integrating a multi-billion-dollar business is never easy.
No, it's incredibly complex. If it takes longer than expected, it could pressure margins.
And there's also the heavy reliance on a limited number of customers in the cloud and AI space, right?
Yeah, the hyperscaler concentration. Losing one of those massive contracts leaves a huge hole in the income statement.
Plus the macro risks. They mention changes in tariffs and trade policies and global geopolitical uncertainty like the conflict in the Middle East.
Right, which directly impacts global supply chains.
Exactly. And just to be clear, we are looking at this impartially as an operational risk disruptions to shipping routes, increase fuel costs, and delay deliveries, which pressures that 8.9% operating margin.
It's a daily logistical puzzle for them.
So what does this all mean? Like, what happens if the hyperscalers suddenly pause their AI capital expenditures for a year?
Well, this is exactly why that 38% stable portfolio matters so much.
The gyroscope.
Right. Medical remains a very stable end market, and traditional U.S. defense business continues to see strong demand.
So it creates a buffer if tech capex dries up.
Exactly. It ensures they aren't left holding empty factories if the AI supercycle takes a breather.
It's a really solid setup. But as we wrap up, what's a final thought for investors to ponder?
Well, think about what happens when the AI infrastructure market eventually matures.
From this rapid build-out phase to a maintenance and upgrade phase?
Exactly. What happens to Sanmina's margins then?
That's a good question.
Will their aggressive expansion into custom optical modules and liquid cooling make their contracts sticky enough?
To prevent hyperscalers from negotiating prices down, you mean?
Exactly. Once the desperation to build subsides, that margin tug-of-war is going to be the multi-billion-dollar question.
That is definitely something to watch closely as this space evolves. Make sure you follow the show for our daily earnings coverage to stay ahead of the markets.